Good morning, dear students. Welcome back. How are you all? Good. Are perfectly fine with their preparations for the exams and also for, not sure how many of you would really going through the articleship, right? So we have a good number of students in the room for taking the discussion of advanced capital budgeting forward. Before we proceed further, let me just quickly recap in approx 5 minutes of what we have done till now, and then take the discussion further. So first, we have looked upon the impact of inflation on capital budgeting decisions. A simple rule that we set is that the rate of inflation will be given to us, so we can definitely calculate the NPV using the real cash flows or the nominal cash flows. Okay. The real cash flows needs to be discounted at real rate of return, whereas the nominal cash flows needs to be discounted at nominal rate of return. Now, which is quite obvious that the nominal rate is going to be higher than the real rate, right? So you can say 1 plus real rate into 1 plus inflation was equal to 1 plus nominal rate, right? One peculiar thing that we learned in this thing was I cannot simply adjust the CFAT for inflation. I mean, cash flow after tax cannot be adjusted for inflation directly, because when we are computing CFAT, there are certain components in which inflation will have nil effect, right? And that was simply the tax savings due to depreciation. So only that portion, which is revenue minus cost into 1 minus T, is going to be impacted by inflation, whereas the depreciation into tax rate, that's not going to be impacted by inflation, right? So we just need to calculate the real cash flows by giving the inflation to this portion and excluding this portion. Okay. Then using the real rate of return, we just need to we need to calculate the real rate of return, discount the cash flows. Then after that, we went ahead with, other aspects wherein we were looking for statistical properties or statistical rules, where we were supposed to measuring the risk of a capital project. And for that, we used the probability models. And those probability models were essentially about, statistical model, wherein we first talked about what is an expected value, what is a variance in expected value, variance in standard deviation, right? So standard deviation expected values and coefficient of variation. So we calculated the expected value by simply multiplying the probability with the respective market price. And to calculate the standard deviation and variance, we subtract the expected value of the NPS from the market price per share, right? And now, of course, this deviation was of no use to us. So what we did is we multiplied the deviation with probability, but we got the total of that to be 0. So we changed it and we said that why are we getting this 0? Because there are certain numbers which are positive, there are certain numbers which are negative. So they're nullifying each other. So we said, let's remove that negative aspect out of it. And therefore, we will say that, let's take the difference square and then multiply that with probability. Okay, so difference square and then multiplied by the probability. The expected market price per share is going to be summation of probability into market price per share, which is a average market price. Variance is nothing but the total of this, which is the sum of square deviation. Standard deviation of market price per share is square root of variance. The square root of variance, that was 85.83 in the market price per share. So we said that the expected value 422.5 can go up by 85.83, or it can fall by 85.83. And coefficient of variation was measuring the standard deviation per unit of the expected value. Okay. And we have done like quite a good number of questions. So we have reached up to question number 3. I'm not sure we're done with question 4. Yes. Question 4 was done. Now let us take the discussion further with now the next question, which is question number 5. Post that we'll also be doing certain questions which are yet to be covered in this probability based models. Okay. So let's go for question number 5 right now. Yes. Question number 5 from the assignment sheet. So here we have it. Okay. Question number 5. Just a minute's time, guys. Just look at the question. Hmm. So what do you have to calculate? We have to calculate the variance and standard deviation, right? Okay, so we have to calculate variance and standard deviation of both the projects. Now, how do we go about calculating the variance and standard deviation? We are pretty clear about it. So like for project A, we have a different set of probabilities, and for project B, we have a different set of probabilities. So for project A, we have the probabilities and cash flow. Probability and cash flow. So probability is 0.1, 0.2, 0.4, 0.2, 0.1. Cash flow is 8,000, 10,000, 12,000, 14,000, and 16,000. Okay. Now these cash flows are given. We want to calculate the variance and the standard deviation. So of course, for that, first we need to get the expected cash flow. Expected cash flow will be probability multiplied by cash flow, right? And then we take a total of it. Yeah. So can you just tell me what's the expected cash flow here? What is the expected cash flow in project A? Yeah, tell me. Calculate and tell me what's the expected cash flow. This is summation of probability into
12,000, sir.
4,000?
12,000.
12,000, okay. So expected cash flow is 12,000. Perfect. Now, get the variance. What we need is cash flow minus expected cash flow. So we don't need the total of it, right? So then we need to multiply this probability with cash flow minus expected cash flow square, and then take the total of it. Right? So take the difference between cash flow and expected cash flow, multiply and take the square, and then multiply it with probability. So expected cash flow, we got it as 12,000. Now I need the total of the last column, which will be representing the variance of cash flows. Of cash flow in project A. Give me the total value. What is the value wise? Variance of cash flows in project A. I just need the total of this.
Sir, it's coming 26 lakhs 40,000. Oh, no, some minute.
6 lakh 40. Doesn't seem to be.
Sir, it's coming 48 lakhs, sir.
48 lakhs. Yes. So variance is 48 lakhs. What can we say about standard deviation of cash flows in project A?
Yeah, it's 2,190.90.
Square root of 48 lakhs. 190.90.
90.
Then the question says also to calculate coefficient of variation. No, we just want the variance and standard deviation. Okay, so we have the variance and standard deviation available. But if I want to compare these two projects, can I just look at the standard deviation? I want to compare these two projects. Can I look at just the standard deviation? No, we need to look at something called as coefficient of variation. Coefficient of variation. Now that coefficient of variation is standard deviation upon expected value into 100. So standard deviation is 210.90 upon 12,000 into 100.
18.66 percentage.
18.66%.
Yes, sir.
One nine zero 0.90 divided by 12,000. 18.26%. No?
Yes, sir. 18.26.
Yeah. Now, same way, we have project B. Again, we need to compute the expected value for that and then compare the coefficient of variation, right? So, can we quickly solve this B part on the similar lines as we did this for project A?
Yes, sir.
Yeah, so quickly do it. I'll just give you 3 minutes time for that. To be able to do this project B, and then tell me which of these two projects is having a greater risk or expected value, and which one should we be really choosing?
Yeah, please show the question, sir.
Yeah.
Okay.
Some network connectivity. think this is sorted now. Yeah. The expected value of project B is expected value of project B. Expected value of project B. Just check if it is 16,000.
Yes, sir. 16,000.
Yes. Okay. Get the standard deviation and the coefficient of variation also. What is expected? I mean, what's the standard deviation? 4195. Yes. Okay. 4195.24. And then coefficient of variation should be 26.22%. So if you just compare, project B is having a higher expected value, and of course, with that, it is also having a higher standard deviation. Right? So higher expected value and also higher standard deviation, with a coefficient of variation being 26.22%. Okay. Coefficient of variation being 26.22. Over here, the coefficient of variation is 18.26. So if I want to really choose between the projects, the second project is having high risk and also higher cash flows. But if I compare both of them together in cohesion, I can say which project are we going to choose? The project B with coefficient of variation as 26.22 or project A with coefficient of variation of 18.26.
I will select project A, coefficient of variation of 18.
The coefficient of variation is lower, 18.26.
Lower.
The risk for every unit of cash flow is lower. And therefore, we should be going with project A. Okay. If the question asks us that based on risk and return comparative analysis, we can say we'll be going with project A. Okay, fine. That's a very simple question. Now let's take the things further with another question of this probability base, but it's going to be something different. Yeah, let's look at this question number 13. It's not a usual expected value thing. There is something additional in this. So let's have a look at it. Let me just place the question here. Okay, so here we have Skyline Airways is planning to acquire a light commercial aircraft for flying class clients at an investment of 50 lakh. This project involves an initial investment of 50 lakhs. Expected cash flows after tax for the next 3 years are as follows. So year 1, year 2, year 3, for the next 3 years, the expected cash flows are given with CFAT and their probabilities, right? So they have been given the cash flow after tax and their probabilities. The company wishes to take into consideration all possible risk factors relating to airline operations. The company wishes to take into consideration all possible risk factors. The company wants to know the expected NPV of this venture, right? Assuming independent probability with 6% risk-free rate, and then possible deviation in expected value. How would the standard deviation of the present value distribution help in capital budgeting decision? Okay, so first expected NPV. We have to first get the expected NPV, and then also we want to calculate what is the deviation in the expected value. So deviation in the expected value is basically we have to get the standard deviation. Okay. So first let us take the, let's consider the expected value and the expected NPV. For that, let's say calculation of expected cash flow. Let us first calculate the expected cash flows. Calculation of expected cash flows. Okay. So we're first talking of year 1, year 2, year 3. So we have like probability, cash flows, and then probability into cash flows. Same way, second year also we are going to look at the probability, cash flows, and then probability into cash flows. Again, year 3, we're going to say probability, cash flows, then probability into cash flows. So for the first year, we have probability at 0.1, 0.2, 0.4, 0.3, 0.1, 0.2, 0.4, 0.3, with the cash flows at 14 lakh, 18 lakh. Now, of course, don't be in a way that, write down the entire value of 14 lakh, because then you will be really, confused as to how many zeros should I put it up, because we're going to square it, we're going to do the deviation. So let's just keep the cash flows as whole numbers. So it's 14 lakhs. So we'll just write 14, 18, 25, and 40. So probability into cash flows, you multiply probability with the cash flows and then take a total. Same way for the second year, we have the probability numbers, right? And the cash flow numbers. Same way, you have to get the probability cash flow number over here and here also. These are basically your expected cash flows in year 1, 2, and 3. Can we calculate these numbers, guys? These numbers, expected cash flows, everyone. Yep.
First year 27, sir.
Okay, first year expected cash flow is 27, perfect. What's the expected cash flow for second year? Expected cash flow for second year is
29,000 lakh 30,000.
29.3, because everything I'm talking in terms of in lakhs.
For year 3, 27.3.
For year
9.
3 is 27.3. No. How much it is?
9.
27 point. Perfect. So we have the expected cash flows of year 1, 2, and 3. Now calculation of expected NPV. Calculation of expected NPV. Now when we have the calculation of expected NPV, we can simply do it as year cash flows, present value factor, and then present value. So we have year 0, 1, 2, 3. So how much is the investment to be made? 50 lakh?
Yes, sir.
Investment to be made is 50 lakh, which is negative 50 lakh. But I'm not going to write down the full value because that's going to really cumbersome to calculate. So minus 50.
The cost
27
of
in the
capital.
first year, 29.3 in the second year, 27.9 in the third year. And the discounting rate is
Cost of capital.
Given to be like 6% only. So there's no other way we can use any other rate. So they've given us like take 6% as a rate. So present value factor at 6%, and then we take the PV. Now take the present value factors of 6%. First year, 0th year is obviously 1. 1 divided by 1.06. This is 0.94.
9434.
And we take up to 4 decimals. 0.8899.
88.
1 divided by 1 divided by 1.6. Then we have 0.8396. Okay. Then give me the expected NPV, multiply the cash flow with the PV factors, take the total, and tell me what is the expected NPV.
$75.2409.
Expected NPV, guys.
Yes, sir. 74.97 minus 50. It will come 24.97.
24.97. Okay.
Yeah.
So expected NPV is 24.97. The expected NPV is positive.
Yes, sir.
The expected NPV is positive. Now we need to calculate the standard deviation. Okay. We need to calculate the standard deviation and variance of this. Now, how do we go about calculating the standard deviation and variance? For that, we already have like the expected cash flow for year 1. The expected cash flow for year 1. We need to get the standard deviation for year 1, standard deviation for year 2, and standard deviation for year 3. So how do we go about it? See, say calculation of standard deviation of the project. Okay, the calculation of variance and standard deviation of the project. So for year 1, we have the data. Probability, cash flows, and probability into cash flows. Since we have this probability and cash flows available with us, what we can essentially do is first take the cash flow minus expected cash flow. Probability, cash flows, and then cash flow minus expected cash flow. Then we take a probability multiplied with cash flow minus expected cash flow square. Okay. So we have probability for year 1 as 0.1, 0.2, 0.4, and 0.3. The cash flows are given to us 14, 18, 25, 40. 14, 18, 25, 40. Now, cash flow minus expected cash flow. Expected cash flow is 27. So 14 minus 27 is minus 13. 13 minus 27, which is minus 9. 25 minus 27 minus 2. And 40 minus 27 is 13. Then probability into this, then take the square of it. So it's like 13 square into 0.1. So this comes out to be 16.9. Then the other is 9 square into 0.2, which is 16.2. 2 square into 0.4, which is 1.6. 13 square into 0.3, which is 50.7. Okay. Now, if you just take a total of all of them, that will be variance of cash flow in year one. Just take a total of it, 16.9 plus 16.2 plus 1.6 plus 50.7, which is 85.4. Okay. Now, what will be standard deviation of cash flow in year one? Now, 85.4, take a square root of it.
9.24.
9.24. This is a standard deviation for year one. Same way, can you provide me year two variance and standard deviation? Year three variance and standard deviation. Okay, sure. Write out, guys. Calculate the variance of year two as well as year three, and then we will talk of what will be the variance in the NPV.
So shows the cash flow alone, cash flow.
Sorry, the question?
Yeah, question, because the expected cash flow, okay.
Do we have this? Get the variance for year two and year three is, then we will look for the variance and standard deviation of the project.
Yeah, this is fine, sir. This slide is fine.
Variance for second year, is it 98.61?
Yes, sir. Standard deviation 9.93.
Standard deviation
9.93.
9.93. And then third year variance is 74.29. And the
Yeah.
standard is 8.62.
8.62.
Okay, perfect. Now this is what we have got the standard deviation variance for each of the years. Now, how do I go about getting the standard deviation for the NP? Okay, standard deviation for the or variance of the entire NPV. Well, we can calculate that by looking at calculation of variance of NPV will be equal to variance of NPV will be equal to variance of cash flow in year 1 discounted by 1 plus R. Right? We generally discount it at 1 plus R. But since variance is a squared term, right, I need to add one more thing over here, which is squared. So then plus variance of cash flow second year upon 1 plus R square. But this will be further getting square plus variance of cash flow of year 3 upon 1 plus R raised to 3. Then this will be further getting squared because in the numerator we are having a variance which is a squared term. And therefore we need to take the square even in the denominator. So here we can say finally the formula becomes variance of cash flow year 1 upon 1 plus R the whole square plus variance of cash flow of year 2 upon 1 plus R raised to 4 plus variance of cash flow of year 3 upon 1 plus R raised to 6. Okay, so this is variance of cash flow of year 1 is 85.4 upon 1.06 raised to 2 plus 898.61 upon 1.06 raised to 4 and then plus 74.29 divided by 1.06 raised to 6. Yeah. So tell me, what's this value? Variance of NPV. Just get these values, guys. 85.4 divided by 1.06 square.
So it is coming 14.37.
15.37. Oh, total of these, I mean, variance, we're talking about variance of the project.
Yes, sir. I total everything. 14.37 is coming.
No, shouldn't be. 85.4. Here. 5.4 divided by 1.06 square. That's 76, the first value. 98.61 divided by 1.06 raised to 4. That's 78.1 and plus 74.29 divided by 1.06 raised to 6. That's m plus. And then when I do a memory recall, that's 206.4856. And that's the variance of NPV. Now, if you want to get the standard deviation of NPV, that will be square root of 206.4856. The square root of this is 14.37.
Yeah, I given 14.37 is the square root of the standard deviation.
We are talking of standard deviation. I was asking for variance. Okay. Very good, guys. See, this is how we get the variance or standard deviation of the NPV by discounting the variance of the future years, but not only simply discounting, but also taking the square in the denominator. Okay. Let's go for another question. Is expected NPV and standard deviation, that is fine. Question number 16. Yeah, this is a really interesting question. Let's take up this question 16 for the discussion now. Following are the estimates of net cash flows and probability of a new project of Messrs. X Limited. So we have like three possible scenarios. In all the scenarios, of course, the initial investment is fixed at 4 lakh. So our initial investment is fixed at 4 lakh for all the possible scenarios. In year 0, you're having an initial investment of 4 lakh. Estimated net after-tax cash inflows per year. So every year the cash flows are set to be like 1 lakh, 1 lakh 10 or 1 lakh 20, depending on the probabilities. Estimated salvage value after tax, it is 20,000, 50,000 and 60,000. Required rate of return from project is 10%. Find the expected NPV of the project, the best case and the worst case NPV. Probability of occurrence of worst case if the cash flows are perfectly dependent over time and independent over time. Standard deviation and coefficient of variation, assuming that there are only 3 streams of cash flows, which are represented by each column of table with the given probabilities. Then what's the coefficient of variation on its average project, which is the range of 0.5 to 1. If the coefficient of variation project is found to be less risky than average, 100 basis points are deducted from the company's cost of capital, should the project be accepted. So first we need to calculate over here the expected NPV. Right? So expected NPV is something that we have to get, then the best case and the worst case, and then we look at the probabilities. Okay. Now, let me just put up this question over there. So how do I calculate the expected NPV? How do we calculate the expected NPV? So initial investment is 4 lakh. Right, so initial investment is 4 lakh and we have to get the expected NPV. So for that, we'll need the expected cash flows from year 1 to 5 and also expected cash flow in year 5.
Year 5 also there is a estimated salvage. We can consider that as inflow.
Consider, yes. Here, calculation. Then we'll talk of the cash flows, PV factor, and then present value. Of course, this PV factor is going to be at 10%. So year 0, there's going to be an initial investment of 4 lakh. So minus 4 lakh. Then year 1 to 5, we have 3 different scenarios. Either you can get 1 lakh, or you can get 1 lakh 10, or you can get 1 lakh 20 with the respective probabilities. So it is 1 lakh into 0.3 plus 1 lakh 10 into 0.5 plus 1 lakh 20 into 0.2. Okay. So 1 lakh into 0.3, which is 30,000, plus 1 lakh 10 into 0.5, which is 55,000, plus 1 lakh 20 into 0.2, which is 24,000. So this comes out to be what? 1 lakh
9,000.
9,000. That's the expected cash flow. Also, in the fifth year, we have got a salvage value. Salvage value is 20, 50, or 60. So we have 20,000 into 0.3 plus 50,000 into 0.5 plus 60,000 into 0.2.
It's coming 43,000.
Cash flow is 43,000. Okay. Take the PV factor at 10% and give me the present values. Take the PV factors up to 4 decimals, please. Take up to 4 decimal and then give me what is the expected NPV. Expected NPV of project. Give me the
So it's
expected
coming, yeah, it's coming 39,900.
39,900. Okay, so expected NPV is 39,900. Somewhere, rounding up error somewhat here and there, it may be case. Okay. Now, next part, the best case and the worst case NPV. Now, tell me under which of these three situations are you going to observe the best case NPV, and which of these three situations are going to observe the worst case NPV?
Best case NPV, it will come on that the cash flow is 1,20,000 and salvage value is 60,000.
Yes, because you have the highest cash inflow over there, right? And worst case will be in the first case?
Yeah, 1 lakh cash flow and 20,000 salvage value.
Yes. So best case NPV will be 1,20,000 into what was the PV annuity factor? It will be 3.791.
3.7908. Yeah,
7908. Okay. 3.7908.
Yes, sir.
And then plus the salvage value is 60,000. 60,000 into the PV factor is 0.621.
10.
And then minus 1 lakh. What is the best case NPV then? 1,20,000 into 3.7908. 60,000 into 0.621 minus 1 lakh. Tell me what's the best case NPV? What's the best case NPV answer is? minus, sorry, it's not 1 lakh, no, minus it is
4 lakh, sir. 4 lakh. It's 92,060.
4 lakh, yes. 92,060.
60. Yes, sir.
Okay, then what will be the worst case NPV? Worst case NPV? What will be the worst case NPV? It will be,
Sir, it's minus 8,580.
1 lakh into 3.7901 plus 20,000 into 0.621 minus 4 lakh.
It's coming minus 8,580.
Minus 8,580. That's the worst case NPV. Simple. Okay, then they say the probability of occurrence of worst case. Probability of occurrence of worst case if the cash flows are perfectly dependent over time and independent over time. Okay, now how do we go about this? See, probability of year and then say probability of worst situation if independent. If 1 year is independent of the other and if 1 year is dependent on the other, then we are going to have obviously different probability. The probability of worst if dependent. Now, year 1, 2, 3, 4, 5. So there are total 5 years. Now, if the situation is independent, when you say situation is independent, sir, there are independent chances that first year you have worst situation and then second year you may have worst situation, but that is not dependent on whether you had the worst situation in the first year. So when you say independent situation, first year there is 0.3 chance or 30% chance that you will have a worst case. Now, second year, there is no connection with the first year. The second year, there is no connection with the first year. And therefore, in the second year, the probability of worst outcome is again 0.3. In the third year, again, probability of worst outcome is 0.3. Fourth year, again, it is 0.3. And fifth year, it is 0.3. Because every year, there is a chance, there is a 30% chance that you will face a worst situation. So every year, there is a 30% chance that you're going to face a worst situation. So probability of worst case, that is 0.3 into 0.3 into 0.3 into 0.3 into 0.3. So probability of the worst case situation, does it look like? 0.00243.
Yeah, 243.
Right. So that's the probability of the worst case throughout the project. So there's a probability of worst case throughout the project. The probability of worst case throughout the project, which is 0.00243. So probability of worst situation, every year it is 30% chance. So overall, the project is likely to have 0.00243. Now, if the situations are like where the situations are independent. So when the situation is independent, first year the probability is 0.3. What is the probability in year 2, year 3?
So it's not independent, it's a dependent.
Dependent, yeah. So if the situation is dependent, when you say dependent, it means whatever has happened in the past, that's going to get repeated. So when you know that probability of the first year is 0.3, that is, worst situation has happened in the first year. Now you're very sure that second year also, it's going to be worst situation. Third year also, it's going to be worst situation. Fourth year also, it's going to be worst situation. And fifth year also worst situation. So every year, you know that you are 100% sure that the situation is going to be worse. So probability of worse comes
It's
out to be
a 100%.
100% sure that you're going to have the worst situation, right? So in this case, what will be the probability that the project is going to have the worst situation? It's going to be 0.3 into 1 into 1 into 1, which is nothing but
0.3.
0.3. Probability of worst situation, if it is dependent, it's going to be 0.3. Okay. Perfect, guys. Probability of worst situation, if it is dependent, that's going to be 0.3. And if it's independent, of course, 0.00243. Okay. So that's question number 3. Fourth is standard deviation and coefficient of variation, assuming that there are only 3 streams of cash flows which are represented by each column with the given probabilities. Now, we want to calculate the standard deviation. Right. So, how do we go about getting the standard deviation and coefficient of variation? Assuming that there are only 3 streams of cash flows which are represented by each column. So basically, I have to get the standard deviation and coefficient of variation by taking this probability and these cash flows. Okay. And then based on that coefficient of variation, we have to decide, we have to decide about whether the project should be accepted or not. So first I need to get the standard deviation and coefficient of variation. Okay, so only 3 streams of cash flows represented by each column of the table with the given probabilities. Now, how do we go about calculating the standard deviation and coefficient of variation? So if we say that there are only 3 streams of cash flows, how do we go about calculating the standard deviation and the coefficient of variation over here, guys? We have the probabilities and there are 3 streams of cash flows over here. Yep. Any idea? How do we calculate the standard deviation?
So we have to find out the expected NPV for all the cases.
Expected NPV for all the cases. Okay.
Then
Then from what are you going to subtract? Yep.
Then okay.
What are you going to subtract from? Yep. Tell me. Idea? Yeah, guys. How do we calculate the standard deviation over here? You just look at the statements. What can we really think of the standard deviation over here? We have got the best case NPV. We have got the worst case NPV also. Now, how do we think about the expected, the expected NPV? See, we have got the best
Yes, sir.
case NPV.
Say we have
The
the
worst
best
case
case as well as the worst case we have. Now we have the best case NPV we can find out, sir, using
Yes,
that
so
1,10,000.
midway, we have computed the best case using this one and worst case using this one. Can we get also the expected NPV with the midway over here,
Yes, sir.
right? So best case NPV is what we have. The worst case is also what we have with their respective probabilities. Now, one thing that we need to calculate is moderate case NPV. Okay. So moderate case NPV is what we can simply compute as just as we did over here. Moderate case NPV cash flow is 1,10,000. 1,10,000 into 3.7908 plus of the salvage over there, 50,000, right? 50,000 into 0.621.
Yes, sir.
And from this, we are going to subtract 4 lakh.
Yes, sir.
What's a moderate case NPV?
It's coming 39,815.
So probability is, what's the moderate case NPV? 30?
39,815.
39,000? No,
39,813, sir.
39,813.
Yes, sir.
The moderate case NPV? No. 1,10,000 into 48.
No, sir. 47,950, sir.
Like 10,000 into 3.7908, which is 4,16,988 minus 50,000 into 0.621.
47,950.
So this is 41,6988 plus 31050 minus 4 lakh. 48,038. Okay, so we have the probability scenarios available, which is 0.3, 0.5, 0.2, 0.3, 0.5, 0.2. Best case NPV with the first 1 lakh, or sorry, worst case NPV is minus 8,580. Then with 50% probability, we can say it is 48,038. And with 0.2, minus 8,580. Sorry, that is 92,060. Now, with these numbers, we can definitely calculate the expected NPV, which is probability into NPV. Then variance is going to be summation of probability into NPV minus expected NPV square. get the expected NPV and then the variance also, and of course standard deviation and the coefficient of variation also. You have the data in front of you, probability and the NPV. Calculate the standard deviation, coefficient of variation, guys. Get the expected NPV, variance, standard deviation, also the coefficient of variation. What's the expected NPV, guys? Yep, expected NPV. The expected NPV will be, I think it should be 0.3 into 8580. One second, I'll just recall memory clear.
So the expected NPV is 42,430. Sorry, it's 39,857.
39,857.
857.
And what's the variance? The variance, standard deviation, also the coefficient of variance. The variance is variance will be simply the total of these terms. We are having the number as 39,857, 8580, 8580 minus 39,857. The other 48,437 minus 48,437, 48,038 minus 39,857. Okay, variance is given as what? 54,657,6946. Okay, 54,657,6946. And if you take the square root of it, you get the standard deviation. So standard deviation is how much? 54,657,6946. We take the square root of it. Oh, some problem. Anyways, let me do it. 9260
Yeah,
minus
73. Yeah.
2203. Now these numbers, let me just do it like 0. Okay. So 48,437 square of it. Okay, you multiply it by 0.3. So I just do it as m plus then 8181 square of it into 0.5 m plus 8181 into 8181 square into 0.5. This will be m plus, and then 52203 into square into 0.2 m plus, and then we do the memory recall, which is 737307. Take the square root of it. Now, variation, it is 1251393267. 1351 393267. Five one 393267. Right, let's take a square root of it. Plus 35. Yeah, 35375. 35375. So coefficient of variation will be 35375 upon 39,857. What is this? 35375 divided by 39,857, which works out to be 0.89. 0.89, or almost it's like, yeah, 0.89 is the coefficient of variation. Now the question says that coefficient of variation on an average which company takes for the project is 0.95 to 1. And it says that if the coefficient of variation of project is found to be less risky than average, so basically if your coefficient of variation is less than 0.95, then 100 basis points are going to be deducted. So of course, since this is less than 0.95, new cost of capital will be 100 basis point below this. So that's going to be like 10% minus 1%, which is 9%. Okay. So new cost of capital is 9%. So now, since we have the new cost of capital, we can definitely calculate, the revised NPV. Right. So revised NPV using 9% as the cost of capital. That's going to be, well, these values that we already have, 1,09,000, 43,000. So 1,09,000 into 1,09,000 into 3 point, what are the PV factor? PV factor 10%, 3.24 plus 1,52,000, which was 43,000, right? Yeah, 43,000. 43,000 into 0.65 minus 4 lakh. That will be the revised NPV using the new cost of capital. What is this number? Please tell me. Revised NPV using 9% as the cost of capital. What will be the revised NPV using 9% as cost of capital base? Sorry, yeah, we just took it at 10% PV factor, right? So what's the PV factor for 9%? It will be 3.8896. And what will be the PV factor for the last year?
0.65. 650.
0.65.
Yes, sir. 0.65.
Yeah. What's the expected NPV? Get the expected NPV, guys.
Yeah, it's 51,916.
51,916. Okay, so that's the NPV value at 9% cost of capital.
Yes, sir. When the cost of capital is reduced, that NPV is increased.
NPV, obviously, it increases. Okay, fine. So that was this question number 16. Now, we have covered the statistical techniques, right? So now let's just go with the next part, which is called as the risk-adjusted discount rate. Like over here, this question 16, we evaluated first the coefficient of variation. And when we found that the coefficient of variation is lower than the normal other projects, we reduce the cost of capital. Similarly, if the risk is higher, we would definitely like to discount our cash flows at a higher rate of return. Right? So a risk-adjusted discount rate is basically taking the risk into account and adding a risk premium to the risk-free rate. So we add a risk premium to the risk-free rate to arrive at a risk-adjusted discount rate. Okay. So we take the risk-free rate. On that, we add some risk premium depending on the risk of the project. If the project is having greater risk, we definitely add a higher degree of risk. Okay. Now that risk can be measured by various methods. It could be by standard deviation, coefficient of variation, macroeconomic situation, right? So that risk premium should be commensurate with the amount of risk that you are undertaking. That needs to be added to the risk-free rate. You get a risk-adjusted discount rate. Okay. So how do we go about that discounting part, and how is that really accounted for? Let us look at question number 6. So question 6, sorry. An enterprise is investing 100 lakhs in a project. The risk-free rate is 7%. Now the management expects a risk premium of 7%. So basically the management wants a total return of how much? What is the total return that the management is asking for? The total return that the management is asking for. 7% is a risk-free. We want a risk premium also of 7%. So total return that we want is 14%, right? Correct. So total return that we want is 14%. So in this question number is what? 6. The question has given us the risk-free rate to be 7%. And the risk premium is 7%. So what is the total return? 7% plus 7%, which is 14%. So total return works out to be 14%. So risk-free rate is 7%, risk premium is 7%, total return is 7% plus 7%, which is 14%. Okay, that's your risk-adjusted discount rate. That's a risk-adjusted discount rate. Now the question says calculate the NPV using risk-free rate and also on the basis of risk-adjusted discount rate. So let me first do it using the risk-free rate. So we have like here cash flows. Present value factor at 7%, which is the risk-free rate, and then you take a PV. The other is you write down here cash flows, present value factor at 14%, and then you take the present value. So here 0, 1, 2, 3, 4, 5, which is 25, 60, 75, 80, 60, 75, 80, and 65. And initial investment that is involved is minus 100. You take the present value factor at 7% and simply take the PV. So it is 0, 1, 2, 3, 4, 5 again. Same set of cash flows, but we're going to discount it at different rates. Now, can you just give me an idea? Where do you expect the NPV to be higher and where do you expect the NPV to be lower?
Sir, on the 14% expected NPV will be higher. On the 7% expected NPV will be higher. On the higher side will be lower.
Eh?
Sir, for 7%, sir, 7%, the expected NPV will be high. For 14%, the expected NPV will be low.
Low. Okay. Perfect. Perfect. So just calculate the NPV and let me know what's the NPV numbers over here is. Get the NPV for 7% and 14% less.
Seven percentage is 144.37.
7% it is 144.37. Okay. Then check at 14%. NPV at 14%.
Sorry, it's 99.85 NPV.
9.85. Okay. Perfect. So the simple idea is if there is a risk in a project, you just add a risk premium and then you discount the cash flow. So in that way, you'll be actually pushing down the NPV to a lower side. Okay, so you'll be pushing the NPV to a lower side. Now, another way of taking into account the risk aspect is something called as a certainty equivalent approach. Now, in the risk-adjusted discount method, we discounted all the cash flows by taking into account the higher rate of discount. So we kept the cash flows as it is. So those cash flows were obviously subject to fluctuation. Therefore, you said the cash flows are risky. Let us discount them at a higher rate of return, which is well accepted. Another way of evaluating this is let's keep the risk-free rate as a discounting rate. Okay. Let us keep the risk-free rate as the discounting rate. And what we can really work on is in spite of keeping the risk-free rate as the discounting rate, let us try to alter the cash flows. Okay. Let us try to alter the cash flows. Now, when we are going to alter the cash flows, essentially, when we are going to discount it using risk-free rate, I will look at only that portion of cash flow which is sure or which is risk-free. Right? So we remove the risk by substituting equivalent certain cash flows from the risky cash flows. So from a series of risky cash flows, you remove the risky component out of it, and you say what is the sure short cash flow out of it. For example, in one of the years, you expect the cash flow to be 1 lakh. In one of the years, you expect the cash flows to be 1 lakh. And I say that certainty equivalent is, let's say, 0.6. Okay. Certainty equivalent is 0.6. 1 second, guys. Okay. So, as you're saying, in certainty equivalent, what we do is we discount the cash flows using risk-free rate. We don't discount the normal cash flows. What we essentially do is we just consider those cash flows which are certain. So let us say we have a cash flow of 1 lakh, on which I'm saying that 60% of these cash flows are sure, 60% of these cash flows are certainly to come up. So if you say that 60% of the cash flows are certainly going to happen, right? 60% of the cash flows, if it is certain that they're going to happen. So 1 lakh into 60%, you can say 60,000 is the sure or the risk-free or the riskless cash flow. So 1 lakh into 0.6, that's 60,000. That's the sure or the risk-free cash flow, right? So 1 lakh into 0.6, 60,000 is going to be risk-free cash flow. And this is going to be discounted at a risk-free rate of return, right? So we remove the risk by substituting the equivalent certain cash flows. Then we discount the cash flows using the risk-free rate of return. Evaluate the project. Normal capital budgeting methods are applied, except in case of the IRR method. Now, obviously, we use the risk-free rate as a discounting method. So let's look at this particular question number 7, guys, in which we are going to learn about the certainty equivalent method. So certainty equivalent, we have, okay. So we have like initial investment of 45 lakh. The risk-free rate is 5%. We have to calculate the NPV under certainty equivalent approach. So certainty equivalent approach, we are going to convert all our cash flows into certain cash flows. So here 0, 1, 2, 3, 4 cash flows. Here 0, we have minus 45 lakhs. Here 1, it is 10 lakh. Here 2, it is 15 lakhs. Here 3, it is 20 lakhs. And here 4, it is 25 5 lakh, but these are the expected cash flows. The question has given us the certainty equivalent. Certainty equivalent, what portion of the cash flows are surely to arise? Right? What portion of cash flows are surely to arise? So first, zeroth year cash flow has got a certainty equivalent of 1 because there's no uncertainty in that we will be spending 45 lakh. Year 1, it is going to be 0.9. Year 2, it is 0.85. Then it is 0.82. Then it is 0.78. Okay. So cash flows, certainty equivalent. And then we say what are the certain cash flows. Okay. So we have the certain cash flows coming in. Certain cash flows is nothing but the cash flow multiplied by the certainty equivalent. So 45 lakh into 1, that entire 45 lakh is an outflow that we are going to witness. 10 lakh into 0.9, that's going to be 9 lakhs. Then you have 15 lakh into 0.85, which is 12 lakh. 75,000. Then 20 lakh into 0.82, which is 16 lakh 40,000. 25 lakh into 0.78, which works out to be what? 19 lakh 50,000. So these are certain cash flows. Then present value factors at the risk-free rate of 5%. And then you take a PV of it. Calculate the NPV, guys, over here. Take the present value factors and at 5%, and then calculate the NPV for the certain cash flows. Get the NPV for the certain cash flows, guys.
So NPV is 5,34,482.
Is 5,34,000.
482.
Just check, guys, you're getting this. Okay. Fine. So that's the certainty equivalent part. If we just do a comparative analysis of risk-adjusted discount rate method and certainty, certainty method is superior to risk-adjusted discount method as it does not assume the risk increases with time at a constant rate. This is like easier to implement rather. Risk-adjusted discount rate is again difficult to implement because you need to first measure the risk. And for that risk, what is a commensurate risk premium? Even calculation of that is a difficult task. Rather, certainty equivalent is superior as it does not assume that with the time the risk is going to increase. And each year certainty equivalent, every year you have a certainty equivalent coefficient number. It is based on the level of risk impacting its cash flow. Now, despite the soundness of the certainty equivalent, it is not preferable like risk-adjusted discount method because to know the risk, certain portion of it, it's a difficult or it's something which is controversial. And also it's not easy for us to specify the certainty equivalent coefficients that we have. Okay. So it's not easy for us to specify the certainty equivalent numbers, and therefore we generally say that both of them can be used depending on what sort of data do we need to have. Now, the next analysis that we are going to make for a given capital project is undertaking something called as sensitivity analysis. Okay. So we are going to undertake analysis or called as a sensitivity analysis. Now, how do we go about this sensitivity? First of all, what do we mean by sensitivity, guys? Can you tell me what do you mean by sensitivity? What do you mean by the term sensitivity?
Sir, if the income is going up to a certain percentage, what is the impact of the NPV? If the cost is increasing or decreasing,
what do you mean by normally a word sensitive?
sensitivity means if we disturb any particular items, it will create its own impact.
So sensitivity is something like, elasticity of demand. Have you learned something called as elasticity of demand, guys? Yeah. Elasticity of demand. You might have learned that for 1% change.
In economics.
1% change. For 1 rupee change in the price, how much is going to be the impact on the demand, right? So in a capital project, we are going to carry out this sensitivity analysis, in which what we are essentially trying to look at is there are multiple inputs that we have in a capital project. Now, multiple inputs would be like what all things are going to have an impact on the NPV. So the final NPV figure is going to be impacted by which numbers? First, the initial investment. Second, the units sold. Then the price at which you're going to sell, the variable cost, the fixed cost, the time period, the discounting rate. All these numbers are going to be something which are subject to change. And if you change those subjects or change those inputs, the final NPV is also going to change. So, for example, if we have a project, capital budgeting as a process, it's nothing. It's a typical information system wherein you have multiple inputs and you have a single output. Right? Input could be like the investment that you're going to make, then units that you're going to sell, sale price per unit, variable cost per unit, fixed cost, right? And then discount rate, time period of the project. So all of them together input, they're going to be converted, they're going to be translated through the process of NPV or translated through some capital budgeting process. And output is going to be that of NPV. So my idea is, if investment increases, if suppose investment increases from your particular given level, what is going to be the impact on the NPV? If your investment, the investment that you're going to make, if that increases, what will be the impact on NPV? What will be the impact on the NPV? If your investment is going to increase, what will be the impact on NPV? Yep. Tell me, guys. What will be the impact on NPV? If instead of original investment, you're saying that investment is going to increase. Instead of, let's say, 100 crore, I need to invest, let's say, 110 crores. So what's going to be the impact on NPV? Can I say NPV is going to reduce? Am I right? Because your cash outflow is increasing, right? As the cash outflow increases, your NPV falls. Due to what change in units, the NPV is going to fall, guys? What do you say? If units sold increases, is it going to decrease my NPV? If the units sold increases, is it going to decrease my NPV? If the units sold increases, is it going to decrease my NPV? Or is it like, when we are going to sell lesser units, when the units are going units to be sold are going to be lesser, can I say NPV is going to be lower? Similarly, when you reduce your selling price, your NPV will be lower. Similarly, when your variable cost increases, your NPV is going to be lower. Your fixed cost increases, your NPV is going to be lower. If your discount rate increases, NPV is going to be lower. Time period decreases, NPV is also going to be lower. So when you are going to change any of these inputs, it will have an effect on the output in the form of NPV. When you change any of these inputs, guys, when you're going to change any of these inputs, the final NPV that you calculate is going to be changing. But what we are concerned about reduction in NPV rather than an increase in NPV. So we are looking for all the different situations due to which the NPV is going to reduce. Okay, we're going to look at all the different situations due to which NPV is going to reduce. So investment is increasing. If your investment increases, NPV is going to fall. If units decreases, NPV is going to fall. So we are going to say that, let's say I'm changing these inputs by 10%. What is the impact on the output that we are seeking for? Right? So we are looking at that particular proportionate change. Okay. So for example, let's say you change and NPV change. Let's say initial investment, you increased by 5%. And the resultant impact on NPV that you see, the resultant impact on NPV is, let's say NPV got reduced by 10%. Sale price per unit, let's say you reduced by 5%. NPV changes, let's say by 12.5%. Same way units, you reduced by 5%. NPV, let's say, changes by 18%. Right? Then variable cost per unit, let's say you increase the cost by 5% and NPV has changed by, let's say 8%. Now, out of these elements, out of these inputs, let's say we're just considering 4 inputs. Out of these 4 inputs, looking at this NPV change, because we have this 5% change. For every 5% change, what is the change in the NPV? Which of these inputs are having a greater degree of variation? I mean, which of these inputs is the most sensitive one? Which of these inputs is the most sensitive one? Units, because you can see the change that is happening in NPV is 18%, which is larger than all other changes. Right? So that is what we are going to discuss in this particular question now. So let us take the question number 18. Right, so let's look at the change. Look at this question number 88. Sorry, not 18. Question number 8 to understand the sensitivity analysis. Okay. So we have like 6 inputs over here: initial cost, annual unit, selling price, variable cost, fixed cost, and the discount rate given to us. We have to calculate the NPV of the project by normal method. That's pretty simple. Then the second is calculate the impact on the project's NPV, considering a 2.5% adverse impact. The 2.5% adverse variance in each variable. Which variable is going to have the maximum effect? You have to consider the life of the project as 3 years. Okay, so we're going to do sensitivity analysis. Got the inputs as initial investment, which is 400. Unit sales is 5. Units sold is 5. selling price per unit is 100. Variable cost per unit is 50. Fixed cost per year is 50. Then we have the discount rate given to us. Discount rate is 6%. Now, we have to look for the revised values for every 2.5% adverse impact. Okay, so we look at what are the revised values with 2.5% adverse effect. So what will be the revised investment value if I want to change it by 2.5% adverse? Can I say investment value should increase? So since it's an outflow, it should increase. So 400 into 1.025, which is 410.
10.
Units sold, since it is 5 crores, units sold is in crores. Of course, the units sold needs to be reduced. So that's going to be 5 into 0.975. How much is this? 5 into 0.975, which is 4.875 crores. Selling price is going to be 100 into 0.975 because 2.5% adverse impact. That's 97.5. Variable cost is 50 into, I need to increase it. So 50 into 1.025. 50 into 1.025. 50, 1.25. Again, fixed cost is going to increase. 50 into 1.025. Again, fixed cost is 51.25, but the difference is fixed cost is what we are talking in terms of crores. Okay, discount rate we are not going to change because percentage change is not applicable over here. So first, let us calculate the base case NPV, right? And then we'll talk of the NPV calculation in the other scenarios. Okay, so we will have a base case, then we will say change in initial investment, then we have change in sale price per unit, change in variable cost per unit, change in fixed cost per unit. Right, so these are the different scenarios that we are going to cover up. Okay. Okay, so coming to the NPV calculation. So first NPV calculation will be, of course, to calculate the cash flow, right? So since there is no taxation and also there is no point of calculating debris and all aspects, so I need to first get what is the cash flow per annum. So I need to write down units, sale price per unit. Then we have variable cost per unit, which will further give us contribution per unit. Then you have total contribution. Then fixed cost per annum. Then you get net cash flow per annum. So units, we say it is 5 crores. Units are obviously in crores in the base case. Sale price per unit is 100. Variable cost per unit is 50. So we will get contribution as 50. Now total contribution will be of course 50 into 5, which is units into contribution per unit, which is 250. Fixed cost is 50 and net fixed cost is so that's your net cash flow. Once we have got the net cash flow, now it's time for us to calculate the NPV. So for NPV calculation, what we are essentially going to do is we have the initial investment. The first case, the initial investment is minus 400. Then present value of net cash flows, which will be net cash flow into present value annuity factor and present value factor at 6% for what is the timeline? 6% for 3 years. Net cash flow is 200 into present value annuity factor 3% for 3 years. Can you tell me what's the present value annuity factor? 2 point. Net cash flow into this. So you have to put 200. The 200 into 2.673, which is 534.6, right? And then we have the NPV numbers. $134.6. Okay, that's the NPV in the first case, which is the base case scenario. Now we are going to change the initial investment, change the sale price, then we will change the variable cost, and initial investment. One more thing is left out over here, guys. Right. We need to also change units. This is like change in units. Change the units also over here. Okay. So here we can say that all other variables are going to change, are going to remain same. Only each one of them is going to change. So units, it will remain 5. Number of units is going to remain 5 crores. Selling price will continue to be 100. Variable cost will be 50. Contribution will be also 50. So total contribution is also going to be 250. Fixed cost is 50. This is also 200. But what is going to change is initial investment, which is going to be 510. Now, of course, you can calculate the NPV according to that. Now, in the selling price part, the selling price is going to change from certain value. So this will continue to be 5. Then what about the selling price per unit? There's going to be an adverse impact. So selling price per unit will be 97.5. Rest all numbers remain the same. And of course, the contribution is going to be changing, which is going to be 47.5, right? 97.5 minus 50, 47.5. What will be the total contribution then? Total contribution will be 237.5. Fixed cost 50. So this comes out to be 187.5. Then initial investment is minus 400. Change in variable cost. So units sold will remain same. This will be 100. Variable cost now is going to be, instead of 50, it is going to increase. So 51.25. So that will give you a revised contribution number as 48.75. Total contribution will be 243.75. Subtracting 50. We get the net cash flow as 193.75. Initial investment is 400. Then change in the fixed cost. So when you change in the fixed cost, this particular portion is going to remain same. Okay. Contribution still remains 50. This total is 250. Fixed cost is 50. Net cash flow is 200. Right. So when your fixed cost is changing, net cash flow, fixed cost is changing. So fixed cost will be now 51.25. So that will give us the net cash flow to be 198.75. Initial investment is still 400. Now when you're changing the units, this is going to be the reduced units, which is 4.875. And the rest all will remain same. 100, minus 50, it's 50, there is 250. No. Yeah, total contribution will be now 243.75. Fixed cost remains 50. And this will be 193.75. Initial investment of 400. Now, based on this, can we calculate the present value of net cash flows, right? And then the NPV values. Can we calculate these values, guys? Present value of net cash flows will be simply 202. This is going to remain same, which is 534.6. But the NPV is definitely going to be a different number. NPV is going to be like, this is going to be 124.6. In the next case, then the change is happening in the selling price. Then
the cash flow is 501.19.
How much?
I'm telling you about the cash flows on the third one, selling price.
Selling prices.
Net cash flow is after discounting that 501.19. The NPV is 101.19.
Okay, you're giving me NPV directly, 101.19.
19.
Okay.
Fourth one, It's 117.89.
17.89.
89. Yeah.
117.89. Okay.
Next to 131.26.
Let's see 1.26. And this is 117.89.
170.89.
Okay. Perfect. So these are all the NPV values. Now, once you have got the NPV values, now we want to see what is the percentage change in NPV. Of course, in first case, it is not applicable. In second case, what is percentage in NPV? 134.6 to 124.6. What is the percentage change? 10 divided by 134.6 is 7.43%. Then 134.6 minus 101.19 is 33.41 divided by 134.6 is 24.82%. $117.89 minus 134.6, 16.71 divided by 134.6 is 12.41%. Then next it is 2.48%. Then it is 12.41% again. So if we talk of sensitivity factor, this is simply percentage change in NPV upon 2.5. Yes, we are changing it by 2.5, right? So input was changed by 2.5. 7.43 divided by 2.5, which is 2.97. 54.82 divided by 0.5, 9.93. Then it is 4.96. Then it is 0.99. And we have 4.96. Now tell me, out of these all factors, which is the most sensitive factor, guys?
24.82%.
Which is 9.93 sensitivity factor, which is the input, sale price.
Yes, sir.
Right? So we can say sale price per unit is the most sensitive input, and company should have sale price per unit is the most sensitive input, and company should have careful control over sale price per unit. So whenever you have sale price per unit, you just need to have an effective and a proper control over that. Okay. So that's how we identify the sensitivity analysis. That's how we carry out the sensitivity analysis, guys. Are we clear, guys?
Sir, how did you arrive at the sensitivity factor percentage?
It is stated over here. Percentage change in NPV, which was this number, divided by 2.5%.
Oh, straight away 2.5%. Okay.
Yeah, because we are changing everything by 2.5, right? So when your input is changing by 2.5, you want to know what is the change in the output.
Yeah. Please work out for only one cases for me, that 2.97, how you got it.
Yeah, 7.43 divided by 2.5. Right?
Oh, okay.
4.82 divided by 2.5, because both terms are percentage, you can directly divide them.
Okay.
Fine. So let us do one thing. Let's take a break right now, guys. Okay. Let's take a break of around 15 minutes. And post that, we will discuss more about something called as scenario analysis, and then we'll have some quizzes, and then I'll take up your doubts accordingly. Okay. Let's take a break now, guys. sensitivity analysis. Now, let us look at scenario analysis. So, when we look at sensitivity, then we have something called as scenario analysis. So, scenario analysis is essentially we are trying to calculate NPV of the project under different scenarios. Now, what's the difference between scenario and sensitivity? In sensitivity analysis, you are changing one variable at a time. Like you are changing only the variable cost or the selling price per unit or the fixed cost. So you're changing one variable at a time, sensitivity analysis. And in case of scenario analysis, we are going to change all the variables which will be pertaining to that particular situation or scenario. Okay. It'll be like all the variables pertaining to that particular scenario. So the scenario analysis brings in the probabilities of change in key variables and also allows us to change more than one variable at a time. So we can change more than one variable at a time, which was not possible in sensitivity, because sensitivity we were testing for sensitivity of each of the probabilities. I mean, each of the situations. Okay. Now, let us say this sensitivity analysis is done. Now, let's look for a scenario analysis problem. Question number 9. So XYZ Limited is considering a project with initial outlay of 14 lakh and there are possible 3 cash flows attached. So in first year, you may get a cash flow of 450, 550 or 650. So it's like, if it's a worst case scenario, you get 450. If it's a most likely scenario, it's 550. And if it's the best case, then it is 650. Same way, year 2, you have worst case scenario number to be 400, most likely is 450 and best case is 500. Same way, year 3, it is 700, 800 and 900. Yes, investing initial outlay of 14 lakhs. Okay. And these all numbers are in thousands, by the way. Okay. This is in thousands. Now, if we say that the cost of capital is 9%, we're going to determine the NPV in each scenario if XYZ Limited is certain about most likely result in first 2 years, but uncertain about third year's cash flow. Okay. Analyze what will be the NPV expecting worst scenario in the third year. Okay. Now we have to look at the NPV in each of these scenarios, and also we will calculate a special scene wherein we are saying that it is certain about the most likely scenario in the first 2 years. So for the first 2 years, you're likely to get the most likely cash flows, and you're uncertain about third year cash flow. But of course, third year will be taking it as the worst scenario. Okay. So now let's calculate NPV under different scenarios. We're going to calculate NPVs under different scenarios. So calculation NPV under different scenarios. Okay. So we'll talk of year present value factor at 9%. Have the scenario as worst likely. Sorry, we will have like worst, most likely and best. And also we have most likely in year 1, 2 and worst in year 3. Cash flows, PV. Cash flows, PV. Again over here, cash flows, PV. And the cash flows and the PV. Year 0, 1, 2, 3. Present value factor at 9%. First year is going to be 1. At 9% for the first year, what's going to be the PV factor? 1 divided by 1.09, which is 0.9174. Then it is 0.8417. And third year it is 0.772. Okay, so initial investment of 1400 is a common number across all the scenarios. If you say it as a worst scenario, first year cash flow will be 450, second year 400, third year 700. In the most likely, it's going to be 550, 450, and 800. Best case, it is 650, 500, 900. Most likely in year 1 and 2, this is going to be 550, 450, and then worst case in third year, so that's going to be 700. Now with these cash flows and PV factors given to us, can you calculate the NPV in each of the scenarios, guys? Calculate the NPV in each of the scenarios. Calculate the NPV in each of the scenarios. Yeah, guys, what's the NPV in the worst case scenario? What's the NPV, guys, in each of the scenarios? Tell me. In the worst case, it is
Negative 109.95.
109. Most likely it is 100.
100 yes, 101.09.
Then it is the best case, it is 31, 2.14. What about the special case, which is most likely in year 1 and 2 and worst in year 3?
23.8.
23.88.
Okay. So we can evaluate the likely outcome of the NPV. We can say that NPV is likely to be in a range of 109, can range from minus 109 to even 312. But expected thing that we can look at is maybe 23.88 as the NPV. Okay. So with that, we are done with the scenario analysis also, analyzing different scenarios. Now it's time for us to take up some MCQ questions, right? And then based on whatever we have discussed till now, let's take up the MCQ questions. And then maybe probably I'll take your certain queries if you have any. Okay, let me just put up the NPV, questions in front of you. Okay, so here we have these questions for you guys. Can I see the questions? Questions, guys. Are you able to see these questions on the screen? Yeah. Okay. Try to answer these questions, guys. 5 questions. So you've got, let's say, 10 minutes for this. Yeah. Try to answer these MCQ questions. What would be the answer for first? So the first question. Project involves an initial capital outlay of 10 lakhs, which will lead to a single cash inflow of 20 lakhs in nominal terms in year 5. So you just have this 20 lakhs coming to you in year 5. The real rate of return is 4%. What's the inflation rate if the project is leading to an NPV of 2 lakhs? So we have the NPV number of 2 lakhs. After 5 years, the 10 lakh is going to become 20 lakhs. The real rate is 4%. So you want to know what is the inflation rate. How do we calculate this? Yeah. Anyone? How do we calculate this? See, it's pretty simple. We know NPV is going to be computed as present value of cash inflow minus present value of cash outflow. The cash inflow is this just 20 divided by 1 plus the rate raised to 5. So this rate is what we're talking of, a nominal rate. So this nominal rate, 20 divided by the nominal 1 plus nominal rate raised to 5 minus 10 is 2, which is the NPV. So of course 10 goes on the other side, you get 20 upon 1 plus r raised to 5 is 12. So 20 by 12 is 1 plus r raised to 5. 20 by 12 is 1.6667 equal to 1 plus r raised to 5, which is 1.6667 raised to 1 by 5. So 5 comes on the other side and you will get the rate as 10.76. Now this is the nominal rate. So we can easily get the inflation rate by using the same equation. 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. And then solving for that, we get the answer to be 6.5%. Okay. Did we get it, everyone? Right? Just a simple NPV equation and you should be able to get the answer. Okay. Are we good with this, everyone? For question number 1, the solution is clear?
Yes, sir.
Okay. Give me the answer for second question now. What is the answer for the second question? The answer for second one? Probabilities are given that being very favorable, favorable, mediocre, unfavorable, or very unfavorable. What's the probability of the favorable situation throughout the project of 3 years if cash flows are dependent? If cash flows are dependent and
0.25,
yes, because 0.25 will prevail. Once you have the favorable situation, you will observe that it's going to repeat every year. So there's a probability of 1. So we just 0.25 will be the answer. Okay, then answer me the third one.
zero point 0.009375.
0.009375. It's simply going to be like you want to know the favorable situation in year 1 and 2, right? So favorable situation in year 1 and 2 will be like favorable, it is 0.25. So it's going to be 0.25 into 0.25, and then in third year you have the unfavorable, the 0.15. So answer will be 0.009375. Okay. Yes. Question. Can I answer which of these is the correct one? So the following is not a technique to measure the risk in capital projects. Which is the option? Which is the correct option? Inflation adjusted NPV, right? Because we are not.
Yes, sir. Inflation adjusted NPV, sir.
Yes.
I'm thinking in between sensitivity analysis and inflation, but sensitivity analysis, we are assessing the risk on that.
Yes, but inflation adjusted NPV doesn't account for any sort of risk involved in it. Okay, because it takes into account adjusting the NPV. I mean, adjusting the cash flows with inflation. Okay, fifth question. Fifth one. Fifth one, read with the answer. In sensitivity analysis, we calculate the revised NPV by taking an impact of change in variable that leads to dash change in NPV. Yeah, which leads to what change in NPV? Higher, lower, or adverse?
Yeah, please give the clarity on the question.
We calculate the revised NPV by changing the variable, right? In sensitivity analysis, we calculate the revised NPV by changing one of the input variables. So when you're changing that input variable, what impact are we looking on the NPV? We change the input variable such that there is a adverse or favorable change in NPV. Adverse.
It will go for adverse, sir.
Adverse, yes. So these are the answers that we have already discussed for the questions.
Sir, how adverse is answer?
Because as we did in one of our questions over here, we were all looking for changing the inputs such that the NPV reduces, or such that there is a adverse effect on the NPV. Right. So when you increased your initial investment, there has to be an adverse impact on the NPV. When you reduced your units sold, you were looking for an adverse impact on the NPV. When you increased your variable cost or increased your fixed cost, your idea was to get an adverse impact on the NPV. Right. So we were looking for some adverse impact on NPV, and that is what we are looking over here. We don't look for the favorable impact on NPV, right?
Okay, sir.
We are through with the MCQs part, and what we have covered in today's session, it prevailed from taking a deeper understanding into the standard deviation part, and most important thing that we have discussed over here is revised NPV. So we have calculated the standard deviation of a project or variance of a project by using this formula, which is variance of first year cash flow, variance of second year cash flow needs to be discounted, but that discounting was happening. Due to variance. So variance was actually discounted by the factors, but it was also squared the denominator. Okay. Then,
sir, is that related to Hillier model?
Sorry?
Hillier model.
Yeah, Hiller. That's called as Hiller model also.
Yeah, Hiller model, yeah.
Hiller model, yes. It's called as a Hiller model. Yeah. Then we also seen what is a certainty equivalent and how do we change the cash flow so that we are in a position to discount the cash flows at a risk-free rate. If we can't do that and we are looking for the risk-adjusted discount rate, after risk-adjusted, we have covered like sensitivity analysis, wherein we were trying to change the inputs so that there is some impact on the output. And always we're looking for adverse impact. And our objective was to identify the most sensitive, most sensitive variable over here so that we can have a close watch or a control over that. And then also scenario analysis, wherein we created multiple scenarios for obtaining the different range of NPVs, right? And we would be wary about one of the scenarios that may be likely to happen. Fine. So with that, we are like covered almost today's agenda. And if you have any queries, you can just post it to me right now.
Sir, in certainty equivalent approach, so, is there any reason for not identifying the certainty cash flow? Any
We are identifying a certain cash flow, right?
Why I am asking this question is compared to any other model, the risk analysis is certainty equivalent is the most appropriate model, but it is a failure because of we are unable to identify the certainty cash flow. What are the reasons for unable to identify that certainty cash flow? That's what I am interested to know that.
Because when it comes to certain cash flows, the certain cash flows are something which you need to look at from a future point of view, right? And what's going to happen?
Bandhuji, can I add something?
Yeah.
Samayatan, I think okay. The answer is your question is very correct. That how we can be certain about some cash flows. It is just like your AFM paper. Okay, in AFM paper, you have a 30 marks MCQs, and with the normally what I have discussed with the student, they say, sir, in the 30 marks, we are certain that we will score 20 marks. So because you know that about 20 marks we can show, because you are from the level of your preparation, generally 20 marks are minimally scored by every candidate. Most of the candidate, hardly I have seen any candidate who has lost the marks in MCQ portion. So to certain extent we are sure, and even one more example, like risk-free, if you notice that whenever we use the certainty equivalent, we use the risk-free rate. Am I correct, Jagbandhuji?
Yes, sir.
Yes, sir. We are using risk-free rate. Yes, sir.
So risk-free rate is basically a kind of for which we have to, of course, everything is uncertain in this world. Nobody knows what will happen next moment. But to some extent, we have to plan, and accordingly, we have planned, and we know that other circumstances are not that volatile. So accordingly, we can say that to some extent, okay, this much will be sure cash flow will be there. Okay, because a company may have some particular type of a customer or a regular customer, or we can say that can be a position can be there. Okay, I hope it is clear to you now.
Yes, sir. There are some limitations are there.
No, of course it is a limitation. This method is very, of course, it is a good method, but it is one of the very this is one of the prominent limitation. We cannot be sure. Of course, we can guess that these are my regular customer, my frequent flyer. That way, even like in case of a government knows that my expenditure for this year, and for the tax, they also can plan if I levy the service tax of this much, GST of this much to this percent, I will get a revenue for the same. So to some extent, certainty is there. Of course, variation is always there. It cannot be 100% sure. Variation will always be there.
Right, sir. Thank you so much.
Okay, student. Thank you very much for making this discussion very interactive. Now we are coming to the end of the session, and here our email ID and phone number are there. Of course, due to some reasons I was busy. I will check my email today or in the morning itself. So if any queries there, you can send us, or you can ask me over the telephone. This is our number. And please note the student, now you are on a Friday. The next class will be of indirect tax. So accordingly, this Bandhuji, this topic will be continued in the next class.
Next class, yes.
And it will be finished off.
Yeah, next class will be done.
It will be done. So now our class will be of AFM will be on the coming Monday. Okay, student. Thank you very much, and thank you, Bandhuji, for sparing your precious time and enlightening the student on this topic. Thank you very much. Have a nice day.
Thank you, sir.
Thank you. Thank you, sir. Okay, Ashok ji, end up session. Have a nice day.